Hello, this is Corner Invest. Today I'll be talking about whether or not the stock market has truly bottomed out yet, as well as Trump's motives behind his tariffs, as well as stocks that I'm looking to buy when the market actually sells off. So over here, Trump he basically imposed 104% tariffs on China, which will be going into effect by tomorrow. So he's doing this because China they didn't remove all the retaliatory measures that they did a few weeks ago. And yeah, I can see this going on for weeks and months and basically all the way until maybe June onwards before he has his midterm elections. This could lead to a lot more pain in the markets, which is what we're seeing right now. So the S&P 500, it was up around 4% at one point. Now it's only up around 0.2%. So it erased an entire 4% up move. And I expect the markets to continue going sideways like this for the next few weeks or so. So I'll be talking about some of the benefits of Trump winning this war. So if Trump wins this tariff war, then there are a few things that he can do. So he can bring the yields down as the economy weakens, can bring more revenue for the government as well as his reputation and legacy. Trump is doing his second term right now, so for him, what he's looking out for is he wants legacy. He wants people to know him for what he does, and that is one of the benefits that he has in terms of this tariff war. But for the detriments of this tariff war, you have a few things over here. You have recession, you have a midterm election loss, you have popularity loss, and so I think all in all, if you have to consider both the benefits as well as the detriments definitely outweigh the benefits over here. So this is what Warren Buffett had to say about the tariffs in his annual report a few months ago before all this unraveled. So he said that, but even with such malfeasance, which remains in full force today, and also much deployment of capital that eventually floundered because of brutal competition or disruptive innovation, the savings of Americans delivered a quantity and quality of output beyond the dreams of any colonist. So what he's basically saying is he's hinting that there are some wrongdoings, and he also said that Trump's tariffs are basically sort of like an act of war. There's no beneficiary of those tariffs. And so for me, I think there are mainly two scenarios over here. Scenario A is that Trump and Xi, they both make a deal, and then the market just moon. But then if Trump and Xi stand up for the next 2 months, then we could continue seeing a lot more downside from here. We could be down another 10, 20% or so. And that is why I still remain conservative in terms of my addings today. As for the general markets in general, so this is what was written by JP Morgan. They basically said that there is panic, sentiment is terrible, but when you talk to people, they say he's not going to actually do it. That is complacency. So what JP Morgan is basically saying is that everyone thinks that Donald Trump is bluffing. He's not actually going to implement those tariffs, which is scary because if he actually go and implement all those tariffs, then this stock market could drop another 20, 30% or so. And then there's a mixed picture institutionally. Retail has been resilient. Retail net bought the most in history in the last week, and then it tapered off on Friday. Typically, retail exacerbates market trends, and we've seen nothing like what we've seen in 2022, where they net sold for 20 weeks straight. So what JP Morgan is basically saying is that retail is not capitulating yet, and that is usually not a sign of a bottom because the bottoms are when normally your smart money buys it up and then your retail sells it down. So that is also why I don't think the stock market has bottomed out yet. And if you're to look at the COVID crisis as well, normally there's a trigger event. So this is by Aswaf Damodaran. So there's always a trigger event, and then the trigger event leads to a sell-off, and then the sell-off could lead to aftershocks as well. Currently, we're still at this phase. We're still in the market reacting phase. We haven't gone into the aftershocks, the real effects, as well as the real long-term effects yet. So if all these ripple effects come into play, then we could go down another 10, 20, 30% even if we go into a stagflationary or recessionary environment. But even with all those that I've said just now, this is what I'm doing. I'm buying stocks and I'm buying companies when they get cheap. I'm not looking to full pot and go long, or neither am I looking to go short in this market environment right now. But I'll be catching the knife on the way down. Let's see how deep it gets. It's impossible for you to time the bottom. So what I'm doing is I'm just adding on tranches as the market continually sells off, and hopefully it goes to around 30% of the highs. Then that will be sort of like my benchmark to add most of my cash positions in already. So with that being said, I'll be talking about a few companies I'm looking to add and I want to add if the market continually sells off. So the first company over here is FICO. FICO is an incredible business. It's a monopoly. So basically what FICO does is they issue out credit scores, and then every single person that wants to get, for example, a mortgage for their car, their house, they need to get this FICO score, and the FICO score usually costs around $5.50 50 cents or so. And for FICO over here, they raised their prices by more than 10x over the past 8 years. That's just incredible for this company. And although the FICO score volume hasn't increased drastically yet, this company is able to exercise so much pricing power, it doesn't really matter to them. So revenue has been up in the mid-teens over the past few years, and you can see earnings exploding. So earnings growing by 20%, and I expect them to continue doing so over the next few years, simply all because of their pricing power. And then they've been buying back shares quite heavily as well. Overall, I think this business is incredible, but the problem with this business is simply just the valuation. It's currently trading at a 78 times earnings, 55 times forward earnings. I would like for it to drop all the way down to a 30 to 40 times earnings. That will be where I'll be comfortable adding, basically around $1,100. And yeah, FICO is an incredible company. That's one that I'm looking at right now. Next company is Moody's. Moody's is basically operating in a duopoly with your S&P Global. So this company over here is sold off a lot recently as well. It is down 12% in the month alone, 15% year to date, and currently trading at a 28 forward earnings. So if you're to just look at the valuation of this company is trading at a price to free cash flow of around 28 times. That is one of the lowest valuation in terms of Moody's recent history. And I think for this company over here, it is just incredible. It is a higher quality business than S&P Global because all it does is it rates all your different bonds. So whenever a company wants to issue bond, they need to get it rated, and they get it rated through 3 different rating agencies. So you have your S&P Global, you have Moody's, as well as Fitch. Moody's and S&P Global combined, they hold about 80% of the entire market share. And that's why this business over here is just incredible. They don't have any capex, they don't have any reinvestment. All they do is they just sit there, and then people will just pay them money to rate their bonds, and all they do is they just use their reputation to go and rate all these bonds. So for this company over here, I think it's just incredible. I'm hoping for a lower price. That's why I'm still holding out for it now. But yeah, around a 30 times forward earnings is decent for a company like Moody's over here, which is extremely high quality. The last stock that I'm looking to add as well is Mastercard. Mastercard over here is an incredible business. I think it is one of the highest quality business in the entire world because they have no risk at all. All they do is just every time when people spend money, they just take a very small fee out of it. It's sort of like growing with the entire economy. It's a royalty business that just grows with the entire economy as GDP grows, as population growth increases and all that. So for Mastercard over here, although it is already an established business, it is still growing revenue at around 12% every single year. And if you're to add on to if you're to add basically their buybacks onto all the different revenue growth as well as some slight margin expansion, this company over here can produce a EPS growth of around 17% year on year, 15 to 17% year on year. I think it's incredible for a business like Mastercard. And this company is one that I'm looking to add as well. But the problem with Mastercard is simply just the valuation. It is not trading at a cheap enough price yet for me to enter. So price to free cash flow around a 32 times right now. Price to earnings is around a 35 times. I would like for it to go nearer to around a 30 times earnings. That is where I'm extremely comfortable adding. So around a 10% more from here, that is where I'll be adding to Mastercard. I would love to own this company. This company will be a 10% position in my portfolio, but it is not at a cheap enough price yet. That's why I'm not adding it in. So as for the markets in general, I think the markets are selling off right now. Oh, it's rebounded. So the markets in general, the market basically the market was up around 4% today, and I expect a lot more choppiness ahead. The market will continue chopping and chopping and chopping as this uncertainty holds, because all the different countries, they have to go and negotiate with Trump. And until they negotiate with Trump and get all these deals done, I expect the markets to continue going sideways or continue going downwards as we price in more and more of the recessionary fears. Hopefully you guys have found this one useful and invest safe.